Welcome traders, Maciej here from Taurus Trading. In this video you will learn about things you must consider to choose the strategy that is right for you. There are multiple ways of making money in financial markets. However, it is very important to be aware of the fact that just because you have found a profitable trading system, it doesn't mean it will work for you, as well as for the others. You might simply not have enough time to spend in front of the screen to look for potential setups. It could be too difficult psychologically for you to hold trades long enough to make sure that these few big winners will pay for all the losses experienced on the way. Finally, the size of one's account may not allow to trade multiple markets, as is necessary, for example, to properly implement trend-following strategy. All these things must be taken into consideration first. Only then we can pick the right trading system accordingly. There is not a one-size-fits-all strategy that works for everyone. Because you have your own personality, what will work for me may well not work for you. If you are quite conservative and feel uncomfortable with contrarian views, then you should probably start with simple trend following. On the other hand, if you are unconventional and like to step away from the crowd, then you can go with the mean reversion system and look for most popular trades to take position against the herd. I consider myself a fairly well-balanced person, therefore I use both strategies in my trading. When you have a big ego, most likely it will be emotionally difficult to apply strategy with lower winning percentage. In contrast, if you don't mind losing a large number of consecutive trades, then you should let the winners run and capitalize on the biggest moves in the market. Different personalities requires different trading systems. Scalping is best suited to active traders that can make immediate decisions and act on those decisions without hesitation. Impatient people often make the best scalpers because they expect their trades to become profitable immediately and they will exit the trade promptly if it goes against them. Day trading as a style is more suitable for traders that prefer starting and completing a task on the same day. Many day traders would not consider making swing or position trades because they would not be able to sleep at night knowing that they had an active trade that could be affected by price movements during the night. Swing trading is compatible with people that have the patience to wait for a trade, but once they have entered a trade, they want it to become profitable quite quickly. Swing traders almost always hold their trades overnight, so it is not suitable for people that would be nervous holding a trade while they were away from their computer. Position trading requires the ability to ignore popular opinion because a single position trade will often hold through both bull and bear markets. For example, a long position trade may need to be held through an entire year when the general public is convinced that the economy is in a recession. If other people easily sway you, then position trading is going to be difficult for you. The other quite important thing is, can your current trading strategy fit in with a day job? If you can't commit between 6 to 8 hours a day, 5 days a week, you should not consider becoming scalper or day trader. These types of strategies requires not only time for trading itself, but also for necessary charts analysis. Perhaps your current job allows you to check the trading platform every hour or so. If that's the case, then pick few stocks indices, couple forex pairs, some commodities like gold or oil, and look for opportunities on the 1-hour chart. Don't be discouraged by overwhelming daily tasks. It only takes up to 15 minutes a day to become successful with trading the longer timeframe charts. If you are happy making 20% return on average each year, then stick with weekly charts. According to many scientific researchers, by watching trends from the bird-eye view, you can not only reduce the costs of trading, but most importantly, it eliminates the market noise. A market correlation is a measure, statistical or observational, that identifies a positive or negative link between the pricing of multiple assets. These relationships are used to determine the direction and relative strength of evolving price action. Correlated markets move in concert with one another, either in a positive or negative fashion. For instance, if market A moves up and market B moves up as well, the correlation is positive. In the event market A rallies while market B plunges, the correlation is deemed negative. When it comes to correlations, it's important to remember that they are not concrete. Relationships in asset pricing often change rapidly and are dependent upon time frame and levels of participation, as well as countless other market fundamentals. During periods of heightened volatility, such as the 2008 financial crisis, stocks can have a tendency to become more correlated, even if they are in different sectors. International markets can also become highly correlated during times of instability. The best way to deal with increasing market correlations is simply to trade one instrument, but having as many variety of parameters as possible. During periods of high volatility, most of the markets will move in the same direction. Due to relatively smaller account size, most beginners are not able to trade 100+ markets and diversify by implementing variety of parameters and timeframes. I recommend to pick one stock index like S&P 500 and apply multiple trend filters, exit techniques, also to look for setups on many timeframes. This way you don't have to worry about trading costs or market correlations. Most of the financial instruments moves are reaction to current stock market situation anyway. Volatility is on average much higher than in forex or commodities, and you can have access to decent levels of required margin. In this example, we can see that a market is in a clear uptrend. You should keep things simple so one moving average can work as a trend filter properly. If possible, using few variations of parameters can help to capture different lengths of the move. For example, you could decide to use 50, 100 and 200 moving average. This way, system parameters are spread evenly. 100 is 2 times bigger than 50 and 200 is 2 times bigger than 100. You can do the same with timeframes and trade 15-minute, 1 hour and 4 hour chart. Again, the difference between parameters is consistent. Each pullback is represented by a few bars in opposite direction. We can enter right after counter trend momentum fades. Try to add as many positions as possible and use variety of methods for exits, like taking profit after reaching 2, 3, 4, 5 times the risk, and the same with trailing stop. If you found this video interesting and valuable, please consider subscribing to my channel. This way you won't miss my new presentations that are already in the work. I will also leave a link to my website so that you can increase the level of your knowledge regarding fundamentals of financial markets by simply getting instant access to the free ebook that I've put together recently. Thanks for watching and see you soon.